Right, wrapped 2 or 3. It wrapped around, right, it wrapped around 2 or 3 black real bodies. So now I would be very, very comfortable doing a trade here. Very comfortable. Risk reward is good. You have a whole bunch of signals here. Yes?
Would you also give weight to the fact that it closed above the previous candle's high?
The question is, would I also give weight to the fact it closed above the previous candle's high? Not too much. Not too much. To me, it's more important that it wrapped around a lot of real bodies. And you're going from lower lows to the same lows to higher lows. Okay. Mm-hmm.
That is confirming your...
Support area. Okay, the question is, the first piercing pattern is confirming our support area, yes.
Then you have the second piercing pattern, but before you have the second piercing pattern, the black candle is closing below your support area.
Okay, before, okay, here's the first piercing pattern. He's saying it's holding the support at the first piercing pattern. This is still holding support there. It didn't close under it. The next one, right, that's what we're talking about. That's, if you were long in the piercing pattern, you would have been out.
Would you consider going short over here?
Yes. Yeah. Yeah. Well, no, I don't. I shouldn't say yes, no. You don't know where the support is, so you don't know if it's a good risk reward. Okay. But based on this, it looks like a descending triangle. Remember, you could use Western technicals. Okay. A descending triangle means you have horizontal support and lower highs. And when the market breaks to the bottom of the descending triangle, you could take the height of the triangle and subtract it. Okay, so that's the way I would be playing it. So let's say we're short and we have a good risk reward. Let's say using the descending triangle as your target, and we're short now. The market broke the support level. In the real world, we're not going to say go from long to short. Okay, unless you have to have good psychology to be able to do that. I love the market. I hate the market. So the market does this, and then once it gets back up here, I would be out of short positions. The question is, would I get uncomfortable seeing this long upper shadow here? I might get a little uncomfortable because it looks like it's confirming. This to me is like a minor resistance area over here. I might get a little bit uncomfortable, maybe scale back a little bit, move up stops. But what I would probably do is look at an intraday chart to see if I saw any real bearish candlestick signals there. So the question is, would I get uncomfortable here and on this long upper shadow? And not too much, but if I saw, for example, a bearish engulfing pattern here on a 60-minute chart, I might get more uncomfortable. Okay, we'll move on to Harami. Okay, a Harami is a small, we're still looking at double candlestick lines. And we looked at spinning tops before, the small real bodies. Remember, spinning top and a small real body mean the same thing. The Harami is a little specific, more specific in its definition. What it means is that it's small real body within an unusually long real body. And the second real body could be black or white. This is a bearish Harami. The Japanese would say there's a change in flow of the market. And a bullish Harami. The market's descending. By the way, these lines, get here. These slash lines just show us the market's moving up. These are not candlesticks. And a bullish Harami is an unusually black real body. Remember the difference in psychology. That's what we're gauging. The long black real body on your right, the bears have command of the market. And then a small real body, black or white, that's within the prior real body. This is non-Forex. How do we know this is non-Forex? What's the difference? What's happening between one candle, one session and the other? Let's look at the bearish Harami. It's gapping. As soon as you see any pattern with a gap, you know it has to be adjusted for the Forex market. So for non-Forex, for Forex, let me show you this also. Once again, bringing out the difference between a bar chart analysis and a candlestick chart analysis. This second black real body within the bearish Harami is also, the way I show it here, is also called an inside session. An inside session is when today's high-low, assuming we're looking at a daily chart, today's high-low range is within yesterday's high-low range. So here, as I display it, is an inside day. But once again, like with the engulfing patterns, all we're concerned about is the real body, or are the real bodies. I'm going to extend the upper shadow on that first spinning top. Okay. That is no longer an inside day, but is a harami. Yes. Real body, small real body, yes.
The upper shadow is longer than the higher.
Right.
I mean, you fine.
Right. So the upper shadow that I showed here is now above the prior upper shadow, but that's not important as long as that real body is within the prior real body. Right? And what's nice about, unfortunately, about the non-Forex is that if we have a candle like this, a harami pattern like this, notice how deeply the market gapped down on the opening, right? And stayed down there. Right? That, to me, is more negative than would be if we had a harami like that. And I think we could see why, right? Because the market didn't gap down. But in the Forex market, that's the way it's going to be. Okay? And a harami, once again, is a small real body within an unusually long white real body. I'll use the bearish engulfing pattern as the dark cloud cover as a resistance area. I don't use harami as resistance or support. That's one difference. Another difference is, to me, with the black real body wrapping around the white real body, the bearish engulfing pattern, the odds of a turn are higher than it would be with the dark cloud cover, right? The black real body only gets partially into the white real body. And the odds of a turn are least compared to those three with the harami. Yes?
Would you say what you said prior to that last statement again?
Okay.
And it was setting resistance levels.
A resistance, okay, I'll use a dark cloud cover and a bearish engulfing pattern as resistance. Remember, you take the high of the bearish engulfing pattern or the high of the dark cloud cover. The highest high of those two candlestick lines will make resistance. I don't use a harami as resistance. Okay, so in other words, here we have that long upper shadow. On the left, I would not use that as an important resistance area. I still would use it as resistance because it could be a pivot high, but it doesn't have the same consequence as resistance as a bearish engulfing pattern or a dark cloud cover. Now, let me ask you this. Where do you think I would be more nervous? What if I saw a harami confirming a resistance area, an important resistance area, say horizontal resistance, and a bearish engulfing pattern that doesn't confirm resistance? Where would I be more likely to initiate a short sale? A harami, yeah. Right, because it confirms a resistance area. If I saw a bearish engulfing pattern that didn't confirm resistance, if I was long and I had some profits, I would probably use it to exit a position or lighten up in a position. And this is really the main difference between using a candlestick signal to enter a new position as opposed to using a candlestick signal to exit. If a candlestick signal confirms a Western signal or another candlestick signal or some group of indicators, I would use that candlestick signal to initiate a new position. If a candlestick signal is not confirming something else, I would use that to exit a position or lighten up in a position. Not all candlestick signals are created equally. It all depends on where they appear through the prism of the overall market. So let's look at harami here. Speaking of harami at resistance,